Collective Mindset Podcast. This is our Wednesday Fed edition, right? We had the Fed meeting today.
December Fed meeting.
Yep, that's the last one of the year, obviously. But we got some really big news today. The Fed chairman, Powell, has essentially come out and told the world that the rate hikes are over, right? We've got the official pause in.
Oh, yeah. Well, yeah, we not only the pause, but the official,
Pivot.
we called our shot, guys. Like, go back a few months, and Gavin and I said, hey, this is peak rates. We talked about peak rates, and I think we nailed that. We hit peak rates.
That was like October, early November.
And it's been straight down since, and it's been a beautiful thing. So I think this is the first time the Fed has actually mentioned a pivot.
Yeah.
So they didn't actually pivot, meaning they didn't cut rates, but they took off the table any future rate hikes and basically said moving forward there will be rate cuts.
Yeah. And I think one of his comments was specifically any tightening actions, right? So that in terms of even other tools that they have in their tool belt, not just hiking rates, like any policy or monetary policy tightening is basically off the table at the moment. So they believe they have done enough to quell inflation, and that those things are in check, and their ability to start cutting rates is going to be starting next year.
Well, the market did a favor for them, because it's really the market, guys, that dictates this. And you saw, like we discussed, that firm rejection when the 10-year Treasury hit 5%, and it just got pushed right back down, and then it got shoved down. And literally today at close, I think it closed at 4.02.
Yeah.
So we're basically at 4%.
A full point lower.
A full point lower.
On the 10-year Treasury.
Yeah.
Right.
So amazing for mortgage rates. A great sign for us in the health of the real estate economy, because we're now trending nicely in the right direction.
Yeah. And I think we're starting to see a little bit of the slack. We've talked about this before, right? Like the margin between the spread between the 10-year Treasury and where mortgage rates land.
Yeah, it's still too high, but
it's still too high right now. But right when the 10-year was at 5%, interest rates were over 8%. So you had 300 plus basis points in spread there. Now, we're down to 4. Let's call it 4 on the 10-year. Interest rates are they're kind of straddling 7%. Like we're in the high 6s probably, but it's like the rate sheet looks a little weird, right? Where you kind of have to pay just a little bit, but you're getting, you're going from maybe 7% to 6.625 for like less than half a point.
Yeah.
So the slack is starting to come out of that, where the spread is going to get a little smaller. And I think as the market continues to buy in that, hey, the pivot is in and inflation's going to be fine, I feel like that spread might continue to shrink, which will help us.
Yeah.
So that's good for mortgage rates, guys. So that everyone here just got an extra, 40, 50 grand in buying power over the last month or so, maybe.
Yeah, probably. I'd have to run the numbers on that, but
yeah,
for us, it's just like, hey, exciting times, and obviously the market just loved that news. There was a awesome rally in the stock market, over 500 points. The crypto market really liked it. Crypto's rallied, depending on the specific coin, but I mean, you're talking up over 5% in generally. Mm-hmm. So that was nice. Gold had a little rally. So everybody wants to see this. The challenge is the data. I guess the question I want to pose is, was there the damage already done? Is there too much damage? Did they sustain these high rates for too long, where the signs of what's happened aren't going to really show again for like the next 3 to 6 months? Because the Fed isn't forward-looking, really. Yeah,
they're looking at, yesterday's data.
Mm-hmm.
Yeah. It's really hard to say, right? Because, like you said, they're looking at old information. They're really just straddling a really tough line, because I think in our world, where we're so dependent on where interest rates are at, like this little drop in interest rates, it's like 1% lower. But it feels big.
Well,
right?
it feels
Compared
like
to what we were talking about
it's
a month or
because
two ago.
it's because we just climbed and we just peaked, Mount Everest, and we peaked, and hey, and now we got to go start going back down, and so it's like, okay, yeah, that way
Yeah.
I can, when I go to my clients and say, hey, I know this rate, at 6.75 today isn't ideal, but you can see the trend. 12 months from now, is this probably going to be 5.75? I mean, that's a conversation you can have when you can see the trend. Whereas before, in 2022 and 2023, we were talking to our clients. We're like, look, you've got to lock in because next week we could be a quarter higher. I mean, it was
Yeah.
just nuts, right? And so it's just this feeling of like, I don't want to quite go to the point of saying it's like euphoric by any means, but there's a sigh of relief like, okay, we've put the hardest part of this is now behind us.
Yeah. So what do you, I mean, you mentioned, right, are we going to feel the effects or is it like, is there more damage or more pain coming, right? Because it's a little bit of a lagging effect or impact from the rate hikes. Like what kind of stuff do you think we would see?
I'm talking like just more like layoffs and companies struggling in
Yeah.
stock and equity markets, not necessarily in housing or in mortgage rates. I'm just talking general like economic conditions as a
Yeah.
whole.
Well, I think if we do sustain a Fed rate, let's say, because their projection, what, like they were sitting like at a 5.25, is that where we're at right now? And now they're talking about next year getting down to 4.6. Okay, so we're going to see a reduction in those rates, but that 4.6%, that is still going to keep like money market accounts and high yield savings accounts. Like those are still going to pay like 4% rates probably next year. So there's not a lot of reason to take on risk. If you're in capital preservation mode, is there a big reason to go take risk? If you feel like the stock market is still risky, if you feel like other things are still, like other investments are still risky, are you going to pull your cash out and start putting it into the market?
That's why I think as far as like the market goes, there's going to be months that look like we're in a strong bull market, and then I think there's going to be months where it looks like we're in a terrible bear market.
Yeah.
It's going to be a real confusing time probably for investors.
Yeah. I feel like
People are going to get caught. So if you're
yeah.
if you're
Well, it's kind of like that. Like everyone's, I don't know if we know exactly what stagflation is, but it's like, right, like it's like where we have high inflation, but we don't have a lot of growth, and so maybe inflation is now over, hypothetically. But I'm just wondering, are we going to start to see growth on the other side of this? And of course, some sectors are going to do better than others, but I'm just sitting here thinking that, I mean, we're so used to debt, and companies are used to debt, and investors are used to using debt to buy things. Like everyone loves their debt so much.
yeah,
Like
we're a debt-based system.
If
I mean,
the
that's how it
debt
is.
is still 4.5%, 4.6%, right? Like, are people going to want to go and put their money at risk and use debt and leverage, or will they even be able to? So I just wonder if like we're not going to see a lot of capital moving into the markets at these kinds of rates. Like,
I think it'll be slower, but it's like just like I said before, though, it's still. If you're an investor or you're someone you're going to look at it and be like, hey, my return, quote unquote, is only going to improve over time as rates lower. I think that's the idea. So, it's going to become more and more and more attractive. And so now it's going to be who can see the opportunity and then seize it prior to becoming obvious to everybody else.
Yeah.
So,
I mean, I think that's the play most people have had to take with just even buying investment properties, real estate right now, right?
Yeah.
Like a lot of times the rents don't make sense with what the mortgage, or the mortgage doesn't make sense. The mortgage payment doesn't make sense with what you could rent the property for. And so a lot of people are kind of projecting, right? Like hopefully they can raise rents. Hopefully those rates can come down. They can refinance in the future. So I guess that would make sense. But yeah, I definitely think we're going to see a lot of kind of, like you said, right? A lot of little mini bull runs and a lot of, pullbacks. Where
that's as far as like stock and crypto and stuff. But I think in real estate, it's going to be interesting to see as like, all of the professional forecasters, National Board of Realtors and Zillow and mortgage, the mortgage lobby and whatnot, as they update their appreciation projections and stuff for 2024. I bet each one of them just added at least another percent to whatever they thought it would do.
Yeah, 100%.
Because how amazing, that obviously we get this is a lagging number, but year over year appreciation, when you saw interest rates go in 2023 from say, somewhere in the fives all the way to 8.5%, most people would have been, mortgage price, or real estate prices would have decreased during that time and depreciated. And nationwide, they appreciated by 3.9%. I thought is a staggering number.
How does that make sense?
That's crazy. And so think about it in the inverse of that. Now we're going to be entering into 2024 where rates are going to be coming down. And if there was already that upward pressure in price with that high of rates, imagine in a rate declining market. And that's why people are like, I just don't see in any world where a crash is coming.
Yeah.
There'll have to be a major event. We can talk about that. But it's like, man, if we stick to status quo in real estate, the way things are and rates are going lower, I don't see how home prices don't continue to appreciate.
Yeah. And I think, right, our, the industry expert, interest rate expert, Barry Habib, he called this a couple years ago that rates would come down super low. That was before COVID, right? And he called his shot. It happened. It was already happening. COVID kind of made it happen faster and maybe a little more drastically. But his reason for saying that was just that the levels of corporate debt, just the levels of debt that we held in the country on the government level, corporate level, just on every level, puts downward pressure on interest rates.
Yeah.
And so inflation happened, right? That pain happened. We had 2, 3, 4 years, like maybe even more, a long time of just sustained inflation that maybe didn't show up in the numbers. But when you're looking at the impact now and how our buying power has been deteriorated, like the only redeeming anything would be for interest rates to get back down low, right? There's no other way we're ever going to get any sort of buying power back except with some leveraged purchasing power through lower interest rates. So that's got to be the hope, I think, right? Because food prices aren't coming back down. I don't know what energy prices are going to do, but it seems like they're trying to push those up as well as a policy, not just as what's happening. The hope is rates can come down, right? So people can afford their lives.
Yeah. The nice thing is we are getting relief in gas prices, which is interesting. I mean, that's a clear sign of a recession.
Yeah.
When gas prices are as low as they are, especially considering the global turmoil that we're facing.
Yeah. It's also a sign of an election year.
Yeah. Let's not get into that.
Right.
So go ahead. I'm sorry.
No, that was kind of just the point I wanted to make, right? We really do need interest rates to come down. Right? Like no one can afford.
Well, we do. The government does.
Yeah.
I mean, the government's got $8 trillion of debt that's maturing and rolling over next year. Imagine if they roll that over, and it's the interest on the debt
5-6%.
Yeah, they need that to roll over, and the interest on that debt's like 4%.
Yeah, it's
gonna feel a lot better.
Yeah, it's just when a starter home is $500,000 in the valley here, that's a $3,500 mortgage payment or more.
Yeah,
right now
it is.
That's tough.
Yeah, well, and think about it. Like builders, like go to a builder and say, "Hey, can you build that home for cheaper?" And they're gonna look at you and say no, because labor cost has gone up. Labor cost isn't gonna all of a sudden go down.
Yeah,
and then all of your hard items, lumber, cement, you name it, like those prices, people aren't just going to all of a sudden start cutting prices.
Yeah. Well, I think this is great news. I think we are trending in the right direction. I think anyone who's bought a home in the last year, guys, we're going to have an opportunity to refinance you here in the coming 12 months.
Yeah.
Maybe even a couple times. Like, who knows, right? Like, interest rates are definitely going to be trending down. That's good for home buyers. If you're still on the sideline and you just think that prices are coming down, no one knows. I don't know. But I would say that I think you're wrong. And I think home prices are going to really start accelerating. And
home builders and sellers are going to take this information to the bank. They're going to be they're going to be like, sweet. Now there's going to be more buyers that are going to come out. And there will be, because more
Yeah.
people can now qualify.
They'll start taking seller concessions off the table. Oh,
Yeah.
that 3-2-1 buy down they were offering, that 2-1 buy down, like not anymore. Like it's going to be back to, hey, here's $5,000 towards your closing costs.
Yeah.
Or here's a free refrigerator. Like,
Yeah, the cool thing is what we would hope for too, you guys, is that you're going to see this re-inversion or flip happen with short-term treasuries and long-term treasuries to get back to a normal level, and that should allow adjustable rate mortgages to come back into play.
Yeah.
As the market's trending down. So it hopefully that happens quickly, so that we can see like, oh yeah, well, let's pretend a conventional loan today is at 7.5. Well, the idea would be like you could get a 5 or 7 year ARM at 6.5. Did I say 7.5? I meant 7.
Yeah.
But like a 0.5% lower or something like that. And then you're like, well, obviously I'm going to refinance this within the next 5 years. And that's when adjustable rate mortgages start to really make sense.
Yeah. Lots of cool things happening. Excited for what the Fed said today. Obviously, their plan, their little dot map that they do for where they think rates are going, it's based on old information, right? So if we have a credit event, if we have a stock market crash, if we have a bank crisis, if we have some other thing, a world war or a big war, like whatever it is, any kind of crisis is going to, like the whole plan's out the window at that point, right? And I think if history is to tell us anything, or at least recent history, that's when they turn the printers on. That's when they do all those types of things that try to spur the economy. So,
what was it that Obama said about Biden?
I don't know. What was it? Lots of things, I'm sure.
Never underestimate Joe's ability to blank stuff
To
up.
blank stuff up. Good old Joe.
So you never know. Like
Yeah.
this next year is going to be very interesting on a lot of levels.
Yeah.
I expect fireworks of all kinds of varieties, but the good news is it should all trend towards lower interest rates the crazier this thing gets. So
Yep. Okay, guys. Well, that's the update. Fed spoke today. Things are moving in the right direction.
let's go. Let us know if you
All right.
have any questions. Thanks, guys.